The day confidence became a currency. Money has never been just paper or numbers on a screen. It has always been belief, fragile and easily shaken. And one day, that belief nearly vanished. To understand why confidence matters more than cash, we need to return to a moment when banks stopped feeling permanent. Long before mobile apps and instant transfers, American banking was built on a simple promise. You could walk in, hand over your savings, and trust it would still be there tomorrow. That promise powered growth, fueled businesses, and turned banks into pillars of daily life. But it also created a dangerous illusion. That trust would always hold. Today, the system looks larger, faster, and more complex. Yet it still runs on the same invisible force. Confidence. When people trust banks, money moves freely. When they don't, everything slows and stops. The pattern has repeated for generations, often in moments no one expected. Each time, the system adapts. Each time, the rules quietly change. At first, American banks were local and personal. Depositors knew the faces behind the counters. Loans were based on reputation, not algorithms. But as the economy expanded, banks grew more interconnected. A failure in one city could ripple across states. What looked like progress was also fragility hiding in plain sight. The early warning signs were subtle. A rumor here, a delayed withdrawal there, small doubts spreading through communities. Most people believed banks were safe because they had always been safe. Few asked what would happen if everyone wanted their money back at once. Then, slowly, confidence began to act like a currency of its own. When it flowed, banks felt strong. When it dried up, even healthy institutions looked weak. The system wasn't collapsing because the money disappeared. It was collapsing because belief did. What followed forced bankers, politicians, and ordinary Americans to confront an uncomfortable truth. The stability of the entire financial system depended less on balance sheets and more on human emotion. Fear could move faster than any transaction. And once fear took hold, no vault felt deep enough. This realization marked the beginning of a new era, an era where maintaining confidence became as important as managing money itself. But the decisions made in response would create consequences that still shape banking today. Once confidence was recognized as the system's weak point, the response was not immediate. Banks continued operating as if trusts were unlimited. Depositors lined up each morning, believing routines meant safety. But underneath, the structure was strained. Banks did not keep most deposits in cash. They loaned them out, invested them, and relied on predictability to survive. This worked only as long as withdrawals stayed orderly. When fear entered the equation, order vanished. One person pulling money out raised questions for the next. A single line outside a bank could turn into a public verdict. It didn't matter whether the bank was healthy. What mattered was what people believed they saw. As withdrawals accelerated, banks were forced to sell assets quickly. Fire sales followed. Prices dropped. Losses appeared where none existed before. A temporary panic began creating permanent damage. Institutions that looked solid days earlier suddenly faced collapse. Not because they were reckless, but because confidence had already left the building. Bankers understood the math. Politicians understood the optics. But neither fully grasped how fast fear could spread. News traveled by word of mouth, newspapers, and whispered warnings. There was no central authority promising protection. No universal backstop. Depositors were on their own. Some banks tried reassurance. Others closed their doors temporarily. Each closure sent another shock through the system. If one bank couldn't open, why trust the next? Panic fed on itself, independent of facts. Logic had no place in the stampede. This was the moment when the old rules quietly failed. The idea that banks could rely solely on reputation and restraint no longer worked in a national economy. The system had outgrown its foundations. Confidence was no longer local. It was collective. Behind closed doors, a new question emerged. If fear could destroy banks faster than mismanagement ever could, then who was responsible for stopping fear itself? And more importantly, how much power should anyone have to do that? The answers would not arrive cleanly. They would be improvised, controversial, and deeply political. But once the realization took hold, there was no turning back. American banking was about to redefine what stability really meant. Stopping fear required something banks alone could not provide. They needed an authority bigger than any single institution. That realization pushed responsibility toward the federal government, whether it was ready or not. Until then, banking had been treated as a private contract between depositor and institution. Now it was becoming a public concern. The conflict was immediate and intense. Intervening too little risked total collapse. Intervening too much risked rewriting capitalism itself. Critics warned that protection would reward bad behavior. Supporters argued that without intervention, even good banks would fall. The debate was not about numbers. It was about philosophy. As panic deepened, hesitation disappeared. Emergency measures were introduced under extreme pressure. Bank holidays froze withdrawals. Temporary guarantees were announced. Officials spoke directly to the public, not with data, but with reassurance. The goal was simple: slow the panic long enough for confidence to return. But confidence does not respond to commands. It responds to belief, and belief needed proof. That proof arrived in the form of government backing. Depositors were told their money would be protected, even if banks failed. This single promise altered behavior instantly. Lines shortened, withdrawals slowed, fear retreated, not because the system was suddenly stronger, but because the rules had changed. Yet the solution carried a hidden cost. By insulating depositors from loss, risk was quietly transferred elsewhere. Banks could now operate knowing confidence was supported externally. The discipline once enforced by fear began to weaken. Stability was achieved, but accountability became harder to measure. Inside boardrooms, strategies adjusted, growth accelerated, balance sheets expanded. If confidence could be engineered, then expansion felt safer. The system appeared calmer, but beneath the surface, incentives were shifting. What began as an emergency response slowly hardened into permanent structure. Temporary tools became standard features. And with each crisis avoided, confidence in the safety net itself grew stronger. Too strong, some argued. The conflict was no longer just about preventing panic. It was about whether a system protected from fear could still recognize danger, and whether confidence, once guaranteed, could ever return to its original meaning. The turning point came quietly, without a single dramatic announcement. Confidence stopped being earned and started being managed. The system no longer waited for trust to form naturally. It actively protected it, reinforced it, and defended it when necessary. This shift changed everything. Banks were no longer judged only by their prudence, but by their importance to the system. Failure became unacceptable, not because it was rare, but because it was contagious. Stability became the priority, even if it meant absorbing risk elsewhere. Over time, this new logic rewired American banking. Crises no longer ended institutions outright. They triggered responses, programs, guarantees, interventions designed to calm markets before panic could spread. Each solution made the system feel safer. Each one also moved responsibility further away from individual decisions. For depositors, the change felt reassuring. Money stayed accessible. Fear faded faster. For banks, the environment encouraged scale and complexity. Bigger institutions felt more secure. Smaller ones struggled to compete. Confidence flowed toward size, not caution. The paradox was impossible to ignore. The system built to prevent panic now depended on the assumption that panic would always be contained. Confidence had become a currency backed not by trust, but by expectation. The expectation that someone, somewhere, would step in. Today's banking system still runs on that promise. Not written on paper, not stored in vaults, but embedded in behavior. When markets shake, people look for reassurance. When reassurance appears, confidence returns. What began as an emergency fix became the foundation of modern stability. And that foundation continues to shape how banks grow, how risks are taken, and how crises are survived. The day